Good morning and welcome to the morning call for Tuesday the 21st of March 2017. Let's go over a few little things that happened overnight, and it's exactly why I've got actually most of the currencies over my shoulder. A lot of Fed speak, and it was quite interesting. You saw Hawker particularly talking about the fact that they expect inflation to actually really tear away and get it past their mandate. What is interesting inside of that, if you actually have a look, Goldman Sachs has a very interesting index called the Financial Conditions Indicator, and it actually dropped below 100 for the first time in over 6 months. And that's very much down to the weak dollar basket. It's also down to the fact that the Fed is clearly impacted. What they also look at inside that factor, corporate bonds and also sovereign bonds. And that weakness is quite interesting because it does therefore mean that there are other areas of the market that are probably picking up on the idea that the Fed is therefore going to allow that inflation to run and therefore may not rein in that inflation number as fast as expected. And that's why last week we saw expectations of probably 3 rate rises in 2017 rather than 4, which is what the FX market was pricing in. Which brings me then to what's going on over my top of my left-hand shoulder, the Aussie dollar. Are we now finally seeing that this is holding in terms of being above 77 cents? We've always been of the opinion that the Aussie had an actual legitimate reason to appreciate from 72 cents on the back of the commodity market back in November. What's been interesting is the fact that the commodity market has actually held up despite the People's National Congress, which I know I've talked about on this several times before, but iron ore is back above 90 US a tonne and holding. You've also started to see a moderation in that really big decline over the last week and a half around oil. That's starting to sort of basically find a floor, which is a really positive thing as well. And then copper, coal, aluminium, etc., all these bulk commodities that are very much tied to our sort of FX is also strengthening on the back of sort of not a huge amount of movement and not a huge amount of volatility coming out of Chinese imports either. And that's a real positive. So that Aussie move is genuine, and that's what we certainly believe, that strength in that US dollar is always going to be the one part you need to be aware of, but it's clearly therefore pricing itself to another level that's probably more fair value in the fact that the US dollar has been severely overbought in some scenarios, and that's why I've also got the dollar basket up there to show you that around 100 is probably fair in terms of what's going on. Otherwhere in the FX market, just to also be aware of, we did actually get confirmation last night that Theresa May will trigger Article 50 on the 29th of March, so next week, and that therefore will be quite interesting. So just keep an eye on cable if you are a bit of an FX trader. Bring back to the equity sphere, it's a really, really interesting period as well. It's very, very choppy. There's a little bit of directionless movement in terms of what's going on, and there's clearly some positioning going. Yesterday, everybody was asking questions about discretionary stocks, and it's probably on the back of what's going on in the housing market. Harvey Norman case in point here, in the fact that you saw NAB and Westpac last week raise rates, and they very clearly told you at their half-year numbers that part of the reason they're doing so well is down to the housing-led recovery and the buying that's bought. So if you do see tightening on the housing side from the banks, that's therefore going to flow through to what goes in the discretionary. It's interesting. I'm not sure I actually myself completely buy it. I actually think it's short interest. Harveys have been very much seeing some big shorts increasing, and that may have explained it, and therefore they may be coming back off it. But JB Hi-Fi was there as well, so maybe it is a bit of a change. But in the main, I actually think discretionary has told you some really positive things, and the momentum is still there, and that hasn't really eased off in the first 3 months, and they told you that at their quarterly update. So something else to sort of look at. Otherwise, today is about the RBA. It's all about their minutes, and therefore their view for pretty much 2017. March was, as expected, didn't move, but China, inflation, and their expectation around the Aussie is clearly the parts that you really need to pay attention to. They are very much asking the question of how do we actually normalise monetary policy? How do we actually continue to stimulate growth in this country, considering that we do have some slight issues, wage growth being one. We also have that concern around the fact that debt to income is so very high on a household level. What do they do around it? The minutes will give you that a bit of sort of colour around that idea, and whether or not there will be any form of monetary policy intervention over the next 12 to 18 months. Personally, I don't think they will. That's where I'll leave it today. Tomorrow, I'll talk to you a bit more about what's coming at the back end of the week. You've got the RBNZ, more Fed speak, and also leading into next week around what's going to go on with Brexit. I think it's quite an important thing and will probably affect your positions. Otherwise, have a good trading day. As always, we are on the phones, 1-800-601-722. Speak to you tomorrow.